Hey everyone, welcome back to Bill's Market Insights. Today we're diving into the fifth installment of our Strategic Asset Allocation series. We all know the old rule: when oil goes down, inflation expectations should cool and bond yields should drop. That's the classic playbook. But right now, that playbook is broken. The bond market isn't playing by those rules anymore, and that creates a massive problem, but also a massive opportunity for your portfolio. Today, I'm going to show you why real estate is currently a defensive bastion against asset erosion. Stay with me until the end because I'm going to reveal the two critical metrics you need to monitor to know whether this strategy is working, or whether we're drifting into a recessionary trap. Let's look at the data. The 10-year Treasury yield just hit its highest point since early 2025. It's completely ignoring the oil market. Why? Because the bond market has stopped listening to the news. It has entered defensive mode. When 30-year yields breach 5%, investors aren't just trading, they're casting a no-confidence vote on the government's ability to service debt. So ask yourself, if big money is running away from US Treasuries, where is it going? It's moving toward hard assets, tangible productive things that don't rely on the printing press. And that brings us to real estate. In this environment, you need a hierarchy. You can't just buy everything. You need to know what holds value when the credit environment turns hostile. First, the leaders. Copper and gold. These are your pure hedges against currency debasement. They are the bedrock. Second, the defensive bastion. Real estate. This is where we can park capital. Real estate is a powerful leveraged inflation hedge, but only when you have fixed rate financing. Your fixed debt service cost erodes as inflation rises, effectively working in your favor. A crucial distinction. Physical real estate is the true defensive bastion. Public REITs are the liquid, market-priced expression of that theme, but they are still equities. So they will move with equity volatility and discount rate pressure. You have to treat them as such. Third, the impairment risk, equities. Growth stocks are in the crosshairs, high discount rates punish them. Fourth, the ultimate loser, long duration treasuries. If inflation remains unanchored, long dated bonds are a trap. But remember, if we hit a hard recession, treasuries become the ultimate flight to safety asset. They outperform everything when the economy crashes. Later in this briefing, we'll look at the indicators that tell you exactly when to pivot between these two realities. So how do we execute this? We're looking at equity REITs and home builders. For REITs, I focus on industrial and multifamily units because they have pricing power. And if you're bullish on the AI infrastructure boom, data center REITs are where that growth is actually hiding. Home builders are your cyclical play. It's not about rent. It's about the fact that building a house is getting more expensive every day. That replacement cost drives value. Real estate is a shield, not a magic bullet. It won't save you if you hit a full-blown recession where demand dries up. To navigate this, you need to watch two separate signals. First, to inflation, watch the break-even inflation rate. If it starts moving in lockstep with nominal interest rates, it confirms that inflation pressure has become unanchored. That is the moment when hard asset pricing logic takes total control. Second, for recession, watch economic growth indicators, specifically unemployment trends and the Purchasing Manager Index. If these start to crack, the inflation hedge narrative will be tested by a demand-side crunch. Here's the execution signal. If the Fed bows to political pressure and cuts rates, but bond yields refuse to follow and instead climb higher, that confirms a sovereign trust crisis. That is your green light. That is the moment to rotate aggressively into hard assets, prioritizing high-quality, cash flow generative positions before the rest of the market catches on. This report is for informational purposes only and does not constitute investment advice. Markets carry risk. Invest with caution.